Adverse opinions require a narrow 1 out of 5 breadth and a shallow 2 out of 5 depth of knowledge. They stand alone at 1 out of 5 in integration and have a low complexity rating of 1 out of 5, making this topic relatively simple. Considering these factors, the overall difficulty score is 1.56 out of 5 or 31.25%. Expect questions on adverse opinions primarily in the AUD section of the CPA exam. This topic has a real-world applicability rating of 3 out of 5 as adverse opinions are crucial in practice but aren't issued frequently. An adverse opinion is a critical form of audit report that signals major issues within an entity's financial statements. This type of report is issued when an auditor identifies significant errors or misstatements that render the financial information unreliable and deceptive. Imagine you're a food critic tasked with reviewing a popular restaurant's new dish that they claim to be a masterpiece. As you dig into the dish, you notice that the presentation and taste are far from what was advertised. The ingredients are not fresh, the flavors are off, and the dish lacks the artistry described in the menu. In this situation, an adverse opinion would be analogous to your scathing review of the restaurant's dish. Your review would highlight the numerous discrepancies between what was promised and what was actually delivered, just as an adverse opinion highlights the discrepancies between the entity's financial statements and the generally accepted accounting principles, also known as the GAAP, that should govern them. In the realm of auditing, adverse opinions stand in stark contrast to unqualified, qualified, or disclaimer opinions. Unqualified opinions imply that the financial statements are accurate and reliable, while qualified opinions express concerns that fall short of outright rejection. Disclaimers arise when the auditor lacks adequate evidence or independence to form an opinion. Receiving an adverse opinion is the most unfavorable outcome, indicating a breach of the GAAP and revealing that the financial statements do not accurately reflect the entity's financial health. Several factors might lead an auditor to issue an adverse opinion on an entity's financial statements, including inadequate disclosures. This is when an entity fails to provide necessary information about its accounting policies, transactions, or events that impact its financial status. Departures from the GAAP. This is when an entity ignores the GAAP standards or makes arbitrary adjustments, distorting its financial outcomes. Unreasonable accounting estimates. Entities using unrealistic estimates for elements like depreciation, inventory valuation, or revenue recognition can prompt adverse opinions. Unjustified changes in accounting principles. Switching accounting methods without proper justification or consistency can also lead to adverse opinions. Consider these 3 instances that could trigger an adverse opinion. Example 1. A retail company values its inventory differently from standard accounting practices, leading to inaccurate financial results without proper explanation. Example 2. An entertainment venue records a significant increase in revenue without providing evidence for the source of this income or its appropriate recognition. Example 3. A tech startup shifts its revenue recognition from one quarter to another without transparent disclosure, influencing its reported financial performance. In each case, an adverse opinion would likely be issued due to the non-compliance with the GAAP distorting the financial picture. An adverse opinion carries severe consequences for the audited entity, including reputation damage. The entity's credibility takes a hit, affecting stakeholders like customers, investors, regulators, and employees. Media attention can exacerbate the situation. Erosion of investor confidence. Investor trust wanes, impacting the entity's financial credibility, potentially leading to lower credit ratings and increased capital costs. Legal and regulatory implications. Adverse opinions opens the doors to lawsuits, penalties, investigations, and sanctions from shareholders, creditors, regulators, and relevant authorities. Hence, entities must address issues flagged in adverse opinions to ensure accurate financial statements and GAAP compliance. Remediation may involve correcting errors, enhancing disclosures, altering accounting practices, changing auditors, or establishing internal controls. In essence, an adverse opinion reflects significant problems within an entity's financial statements. It highlights the auditor's discovery of substantial deviations from the GAAP, rendering the financial information unreliable. The impact can be severe, affecting an entity's reputation, investor trust, and legal status. If you found this video beneficial, I'd greatly appreciate it if you could give it a thumbs up. If, however, there are areas you believe could be improved, or if you have any suggestions for future topics, please don't hesitate to share your thoughts in the comment section below.